Hi there, Bryce Holdaway here, co-host of Location Australia and partner of Empower Wealth. And today I've got a very special guest with me, the Chair of the Property Investment Professionals of Australia and most recently awarded the Property Investment Advisor of the Year. Congratulations, how does that feel?
Yeah, great, Bryce. It's an absolute thrill to be recognised by the peers and also to get that feedback from the clients who are really satisfied with the work we do here. But I'm not going to take that award just on my own. I mean, it's a team effort with what we do here. We've got some amazing tools that help us, inform to make the best decisions for our clients. And second to that, we've got research and those types of things, which is giving results to our clients. So, to take an award on like that is really about Empower Wealth as opposed to just about myself.
Ben, one of the things I want to talk to you about today is the Smart Property Investor magazine and the Property Investment Professionals of Australia have recently sent out a report based on the sentiment of the property investment industry. And there's a couple of interesting findings in here that I want to chat to you about. And the first one here is they've talked about the fact that there's a clear relationship between the low interest rate environment that we're currently in and the propensity for someone to want to invest in property. So do you have any thoughts on that?
Look, that relationship's been around for a long time. If we actually have a look where affordability is increased, then values normally grow. So once it becomes more affordable to buy property, more people consider that. And investors aren't silly. They know that that's the time to also look at things. But I'd say the really smart investors should buy counter-cyclical as opposed to following the rest of the market. So while we're seeing a lot of this media attention at the moment is in terms of house prices growing is because what's naturally happening is, a husband and wife or first home buyers are going down and speaking to their mortgage brokers, working out what they can borrow and, sort of saying, oh, we probably don't want to spend that much. We probably want to spend a little bit less than that. But then they go out into the marketplace and work out what their money buys them and just natural through human nature, they actually end up buying at their higher end. So that obviously pushes prices up over the long term whilst you've got low interest rates. From an investor's point of view, when you've got low interest rates and reasonable yields as well, it means that the shortfall between holding that property from the interest that you might be paying is less. So it's less out of the family budget, and I think more and more people consider that to be a good time to invest.
Ben, one of the interesting parts about this survey was that a very high percentage, in fact almost 65% of respondents said that they would prefer existing stock over brand new stock. Is that consistent with your philosophies on investing?
Yeah, I do. I mean, we do get to see a lot of media and certainly a lot of advertising around new stock coming to market. I mean, once you get new accommodation and new product coming to market, there's a marketing budget behind that. So you open the papers and you look online and you see all these developments, they're spending money to try and get interest on the radio and so forth. So a lot of people think that, maybe it's new stock that's the best way to go. But the seasoned investors, which is really what this survey has tapped into in terms of the respondents who have replied to this survey, they're actually pretty reasonably sophisticated in terms of how they're investing, and they have a clear preference to existing. And the reason why they probably have that is because when you're buying something new, it's uncertain. You're buying into the future, it hasn't necessarily been built, it's off the plan or it's house and land package. Whereas when you're buying existing, what you're actually getting is some proven resale. It's been tested in the marketplace. You're able to do your comps better in terms of what it's worth. And I think smart investors are working that out to sort of say, okay, well, this new stock that's coming on the market that's going to improve the value of that median for that particular product type in the marketplace. Well, the smart investors coming in under that and riding on the coattails and taking that wave ride up higher in terms of their returns.
Now, you did talk before about counter-cyclical investing, and for that reason, there's a lot of interest in Brisbane right now. But do you still see a case for investors still considering the big markets of Sydney and Melbourne?
I do. They're just such large markets and they're our international cities. And if you're looking for where the value will grow over time, I mean, when you've got low interest rates like this now and you've got high borrowing powers, everyone can get into the game. And they do buy, because the rising tide's lifting all ships, so all suburbs are seeing price growth. But once we see over history, the actual areas that deliver the outperform results are the areas where the income growth is strongest. And historically speaking, the strongest suburbs have, on average, higher income growth over time than the other suburbs do. So we still like to cherry pick in those blue chip areas when we can, right, and look for the regentrification areas that are also occurring as well. And that's more about timing. The blue chip's about you know, if you can afford, get in and hold and stay. The timing the market in the regentification areas is really important. And once they regentify, you know, you're going to see some really smart growth. So that's all about timing. And then when you come into, you know, the other markets, which are the flow-on markets, the wave riding markets, I suspect they're going to have a poor return over time. So that's the sort of outer suburb areas and the areas that might be showing good yields. And so the investors are seduced by a high yield. But in reality, you know, where's that growth going to come from if the actual overall income of that area isn't growing? So if the lifestyle drivers is the status of the area is not right, you're not going to see, you know, returns as high as what you're going to see in those other areas. Now, when we come to Brisbane, Brisbane's an interesting marketplace because we've seen Melbourne and Sydney's affordability generally, you know, cap out. Certainly Sydney's very much capping out at the moment. So, you know, if you take a macro view and you say, well, what do you think about Sydney? My commentary is, yeah, I'm a bit over concerned about Sydney at the moment. It's fair. It's a fair assessment. Melbourne coming to that point. But inside those markets, yes, we can still find opportunities. Brisbane, on the other hand, well, you know, we're still in a lag stage in terms of the price growth. So generally speaking, there's still a rising tide that's going to lift all ships. But I still wouldn't be buying in certain areas of Brisbane. I'd still be focusing on the same theories and the same methodologies that we've used to successfully get great purchases and great returns for our clients, both in the Sydney and Melbourne market, into the Brisbane market over the coming 6 to 12 months.
Well, one of the interesting findings that I found here too is that 60% of the respondents said that not being able to meet your loan obligations was a real worry for them. It was by far the biggest concern they have. But further on in the report, it talks about the fact that being able to meet your loan obligations, less than 3% thought it was difficult or very difficult. Do you find that interesting?
Yeah, look, I mean, in sitting down and talking to hundreds and hundreds of clients and talking about their financial affairs, it's very clear that from a mindset point of view that your state of wallet plays with your state of mind. So when, you know, the cash flows are there, you're still thinking about the future and you can build up anxieties and worry around that. But what is interesting is once we get that client over the line or they get themselves over the line with the confidence around seeing their numbers in real life and seeing all those future plans that they're actually getting themselves to a confidence score that says, no, we can do this and we can afford it. And then interestingly, 6-12 months later, and I know from my own personal circumstances with, you know, over $1 million in lending in my household, that you don't necessarily worry about it because it becomes part of the work you're doing and it's part of the overall thing. I mean, at the end of the day, we'd love to see no lending as part of our investment strategy, but the reality is to invest in property and to get that leverage and to get that accelerated outcome, you've got to take moves around your debt and you've got to make those sensible decisions. So, but once they get over that, or, you know, their confidence score lifts up and off they go and they get more and more comfortable with debt.
Now, Ben, it was interesting also to note that of the investors that were surveyed said that 65.5% of them said that for their next loan, they'd like to use the services of a mortgage broker. So do you have any feedback on using sort of the traditional avenues of going directly to the bank versus using a mortgage broker?
Yeah, look, the jury's in. You know, mortgage brokers are taking more and more share away from the banks as consumers are getting more informed about their proposition in terms of how they look after the client. And the fact is they work for the customer. They're not working for the bank, you know, so they've got a choice of lenders available. And second to that, for the specialist investment advisor, so that finance advisor who specialises in getting structures right and making sure you're separating non-deductible debt from deductible debt and you're keeping investments, you know, uncross-securitized and those types of things. You know, if I'm going to a local bank mortgage writer, I may not be getting that sort of training or that expertise. So if I was going to look to invest in property or I am investing in property, I'd certainly want to sit down with someone who's got some real experience or does the investment structuring and strategy every day as opposed to just going and get a transactional loan from a bank.
Ben Kingsley, congratulations again on what I think is a very well-deserved award, being the Property Investment Advisor of the Year, and good luck for the rest of the year ahead.
Thank you, Bryce.
Now, if you're interested in getting a copy of this report, you can download from this page and look through it yourself and see exactly what those responses were. And equally, if you'd like to spend some time with the Property Investment Advisor of the Year, feel free to fill in your details and Ben would be more than happy to discuss your particular circumstances and see if he can find what opportunities exist for you.